Okay, I just want to take the opportunity to introduce a few of the different categories of derivative contracts which exist. So, first of all, the first two distinct categories that come to mind are contingent derivatives and commitments. So in the first instance, contingent would be a kind of contract where you, on entering the contract, you are not committed to the transaction. So, for example, in a call option contract, you have the option to buy the underlying asset. For example, a stock index. You have the option to buy it if you wish to at the expiration date, but you do not have the obligation to buy it if the transaction is not favorable to you at that time. So in that way, it's more like a kind of insurance contract rather than a future commitment. On the other hand, a commitment would mean that you have to carry out that transaction at the expiration date. Of course, you can close the contract out beforehand, but if you hold it until expiration, you will have to carry out the commitment. You are obligated to the transaction that you've promised to incur on the expiration date. So in both cases, we can further split these down into exchange traded and over the counter. Again, exchange traded and over the counter. So exchange would be, for example, an option on a stock index, for example, the S&P 500 index. So these are standardized contracts that have a secondary market available where you can buy and sell existing contracts after they've first been introduced. The over-the-counter contract, on the other hand, are private arrangements between two parties, probably quite often between a corporate entity and a bank would be a good example. So, for example, it would be an option, a customized option provided privately by a bank to a corporate in order to mitigate a corporate risk. And it's a kind of insurance provided to the corporate, and the bank will seek to offlay and hedge that risk into the market, but they will take the commitment from the corporate. So, all right, let's look at some of the individual types. So we've got options on assets. So in this case, we've got call options and put options, for example, on indexes like the S&P 500, or call and put on individual shares, for example, Walmart, or it could be options on currencies, forex, or bonds. So these are actual assets. Another one are options on rates. So in this case, you're not it's not an option on the bond itself, but on some category of interest rates. So it's the percentage. Okay, next off we've got warrants. We've got options on futures. Yeah, so in fact, the S&P 500 wouldn't be an actual asset. An individual share such as Walmart, a stock such as Walmart would be an asset in itself, but the S&P 500 contract is actually a future, so that would be an option on a future, on a futures contract. Okay, we've got callable bonds, which are not an actual derivative in and of themselves, but by containing an implicit call, they have a derivative within the bond. incorporated into the bond. Okay, and we've got also convertible bonds, which in the same way are not derivatives contracts in themselves, but they contain a derivative in that they have the convertibility into equity under certain conditions. So it's a bond with a derivative component packaged inside it. Okay, so over the counter we've got, many of them are the same, just that they're private transactions and not traded on a secondary market. So options on assets, options on rates, warrants, options on futures there aren't, because those are highly liquid, traded on exchanges, and there's no need for them over the counter, since a highly liquid market already exists for them on the exchange. So we'll go straight to callable bonds. Convertible bonds, exotic options. So this might be some kind of complex instrument that's created by a bank to meet the exact needs of a corporate in order to offlay an existing risk that they have, for example. And then we've got asset-backed securities. This could be a good example of this would be mortgages. So these would be probably traded directly with the bank and not over an exchange in many cases. Alright, exchange traded commitments. We've got futures contracts. For example, the commitment to buy a certain amount of euros selling dollars on a specific date. Then the equivalent of futures in the over-the-counter market are forwards. So in the private market, a future is called a forward, and this is an agreement, a forward agreement, to carry out a specific transaction on a future date. So you are obligated to carry out the transaction. These are normally held until maturity, whether these are not necessarily. Again, we've got swaps. Good example of swaps are interest rate swaps, where one party swaps a fixed rate for a variable rate from another party. So if you're borrowing money at or if you're earning interest at 5% fixed, for example, perhaps you've got some mortgages that you are earning 5% fixed rate, and you want to swap the 5% fixed rate for a variable rate. Then after taking on the swap, you will receive a variable interest, and the other party will receive your 5% fixed rate in exchange. Okay, that's it.